Polls.
Thank you for having me.
Yeah. And we thank you for being here, Barnaby.
Somewhere right now, as we speak, a commercial real estate broker is telling a prospective seller or buyer it's an 8-cap deal. And that person, whether they are looking at an apartment building, a storage unit facility, or maybe an industrial park, is nodding along, pretending they are fluent in this secret language of valuation.
Right, playing along.
But deep down, the question lingers. What does that number actually tell me, and how do I know I'm not being completely played?
That internal uncertainty, that moment where financial jargon feels like a weapon aimed directly at your wallet, that's precisely what we are diving into today.
Okay.
The capitalization rate, or cap rate, it is simultaneously the most quoted, the most misunderstood, and honestly the most abused number in all of commercial real estate valuation. It really is.
Our mission today, then, is to pull this metric out of the shadows. We're breaking down what the cap rate actually means, why almost universally people use it incorrectly to justify, aggressive pricing, and most importantly, how you, the listener, can extract the essential protective knowledge needed to navigate this metric. We want you to distinguish the cap rate as a simple sort of directional tool from the highly manipulative instrument it's become.
Exactly. You need to avoid getting mugged in math language, basically.
Mm-hmm.
And we have to internalize the simple truth of the cap rate first, I think, before we can truly appreciate the complexity and, frankly, the danger of the lie often wrapped around it.
Okay, let's unpack this then. We have to start with the foundational purpose, right? The capitalization rate.
Mm-hmm.
Its original intent was almost, naive in its simplicity.
It really was. Back in the day, before all the complicated debt instruments and the financial engineering that makes modern deals spin, the cap rate was designed to be pure.
Pure. That's a good word for it.
That's the key term.
Yeah.
Pure. Its original intent was simply to represent the return on investment if, and that's a big if, you bought the property entirely in cash.
Ah, okay. No loans involved.
Exactly. Think of it as a yield calculator just for equity. No loans, no mortgage payments, no debt service to muddy the waters. It existed purely for a clean, quick comparison. Asset performance versus asset price across different properties.
And mathematically. You absolutely must lock this definition into memory. This is the precise mathematical definition everyone has to hold on to, even when the conversation later moves into aggressive valuation territory.
Right. The formula itself is beautifully simple. Cap rate equals net operating income, or NOI.
NOI, yeah.
Divided by the purchase price. That's it.
Okay, NOI divided by price.
And if we use the foundational example, the relationship becomes instantly clear. Let's say you have a property that generates $100,000 in NOI.
And remind us, NOI is revenue minus operating expenses, but before debt.
Exactly. Revenue minus all operating expenses, taxes, insurance, management, utilities, repairs. But crucially, before debt service, mortgage payments, and major capital expenditures like a new roof.
Got it. So $100 K NOI.
And you purchase it for $1 million.
Yeah.
Then $100,000 divided by $1 million gives you
0.10 or 10%.
a 10% cap rate. Simple as that.
That 10%, that number, represents the return a buyer would earn annually, based purely on the income generated by the property itself. This is the unleveraged initial yield.
Yes, unleveraged. It crucially tells you what the property asset itself is generating, irrespective of how you, the investor, are funding it. Are you using debt? All cash. It doesn't care.
Right. It strips everything back to the basics of performance against price, which I guess made it an irresistible shorthand.
Totally. But that initial simplicity is exactly what led to its downfall and eventual, weaponization.
How so?
The shift from a genuine analytical tool to just a promotional talking point is striking. As our research notes, the cap rate started as a flashlight, a simple directional beam for illuminating objective value. You could point it at a deal and see the basic return.
But it quickly became something far less helpful, didn't it?
Exactly. It has since become, and I love this quote, a strobe light in a nightclub of nonsense.
Aha. Okay, paint that picture.
Well, when you are using a strobe light, everything is obscured, right? The inputs are flashing so rapidly, the valuations are changing, based on perception rather than reality. Nobody can actually see the underlying fixed reality of the asset.
Flashes of potential income, flashes of minimized expenses.
Precisely. The flashlight shows you the fixed value. The strobe light is intentionally disorienting, making the room, the deal, look much more exciting, maybe much better, than it actually is in the cold light of day. And this is where we really need to introduce some healthy skepticism, because the math is sound NOI divided by price will always give you a mathematically correct ratio. That's not the issue.
Okay.
The conspiracy, if you want to call it that, the core reason this number is used incorrectly, is the willful, often aggressive manipulation of the inputs to that math.
So we're talking about seasoning the deal, right? Brokers aren't performing mathematical wizardry. They're just adjusting the variables in the equation to get the result they want.
That's a perfect way to put it. They use cap rates, like expensive seasoning, to enhance the perceived value of an otherwise maybe bland investment, making it suddenly look gourmet.
Okay, so how do they do it? What are the tricks?
We can detail the specific, common ways this manipulation is achieved. We call them the 3 levers of cap rate adjustment, and understanding these is really your first line of defense.
All right, lay out the first lever, the one that deals with the income side of the equation, the NOI.
Okay, the first lever is fundamentally about manipulating the net operating income. This is probably the most common one.
How?
Instead of providing the current collected and proven figures, what we call the trailing 12 months, or T12, which is the historical gold standard of financial verification.
The actual results from the last year.
Exactly. Instead of relying solely on that, brokers will introduce future projected rents. They'll show you the T12, maybe, but then they immediately pivot. They'll say, look, the current NOI is $100 K, but if you aggressively raise the rents to market rates next year, or, fill those 3 vacant units, the stabilized NOI will be $120K.
Wait a second, isn't that just selling potential? I mean, I'm supposed to pay today's price based on the assumption that I, the buyer, will execute a perfect plan that the current owner couldn't or maybe wouldn't execute.
You hit the nail right on the head. That's exactly it. You are valuing the property not based on what the asset's doing today, but what the property might do, maybe in the hands of a hypothetical perfect operator under ideal future conditions.
And that inflated theoretical NOI automatically justifies a much higher purchase price in the cap rate formula.
Instantly. Price equals NOI cap rate. If you make the NOI bigger, the price jumps up.
Without any actual performance change today.
Wow. Okay, so if they can't inflate the revenue side, what's next? Shrinking the costs. That's the second lever, manipulating the expenses.
Yeah.
If you want to make NOI bigger, you can also make the expenses look smaller.
How's that done? Just leave stuff out.
Often, yes. It's done by subtly deleting or minimizing crucial costs from the T12 data they present. For example, they might exclude a major irregular utility bill from the past year, calling it a one-off.
Or capital expenditures, things like replacing a roof.
Crucially, yes. They may ignore necessary capital expenditures or fail to include adequate reserves for future repairs. A big one is deferred maintenance.
Can you give me a tangible example, like a pesky bill that just vanishes?
Certainly. Let's say the property has an aging HVAC system or a roof nearing the end of its life. The owner knows they should be setting aside, say, $15,000 annually for deferred maintenance or future capital reserves.
Yeah, saving up for the inevitable replacement.
But they don't include that reserve as a necessary operating expense in the package they show you. Or, another common one, they might exclude the cost of a full-time property manager because the current owner managed it personally and saved that fee.
But the new buyer will likely have to pay for management.
Almost certainly, unless they plan to manage it themselves, which is a real cost in terms of time. The result: the reported NOI is inflated by maybe $15,000, $25,000, even more sometimes.
And then the buyer takes over.
And bam, those costs immediately reappear as immediate operational duties or necessary expenditures. The real cap rate, the one based on actual sustainable operations, drops instantly.
So the buyer gets the property and suddenly they realize the 8 cap they thought they bought is actually a 7 cap. Or worse, maybe a 6 cap, because they have to spend real money on deferred expenses and necessary management fees. That's a massive blow.
It is. It's a rude awakening. And the third lever is perhaps the hardest to fight sometimes because it feels more subjective, manipulating the rate itself.
How do you manipulate the rate? Isn't that set by the market?
Well, that's the common misconception we'll tackle later. This manipulation is achieved by anchoring the buyer's expectation using, frankly, false comparisons. Brokers will quote market comps, comparable sales from entirely different, often superior, geographical areas or property types.
So if my challenge property is in a, let's say, secondary or tertiary market, the broker pulls up a sale from a shiny, new Class A property in a booming downtown nearby.
Exactly. Or maybe a different asset class altogether that typically trades at lower cap rates. They're comparison shopping for the lowest possible cap rate to justify the highest possible price, not the most accurate one for your specific asset.
They leverage the psychological effect, right? Seeing a low cap rate in a prime area and trying to graft that perceived safety or desirability onto a riskier asset.
Precisely. It's all about perception management.
This aggressive pricing, based on inflated future projections, minimized expenses, cherry-picked comps, the different parties involved must have names for this, right?
They absolutely do. Buyers, when they see prices driven up relentlessly by these theoretical inputs, they refer to this phenomenon as cap rate compression. The perceived cap rate is aggressively squeezed or compressed downward, which, because math, geometrically drives the price up.
Makes sense. Compression forces prices higher, and sellers, watching their potential sale price climb on paper.
Sellers, understandably, often just call this aggressive valuation hope that someone will believe the story and pay the inflated price.
And then there are the lenders, the banks, the ones with actual skin in the game, needing the property to perform to cover the loan.
Right. They are the ones actually risking capital based on the property's ability to service the debt based on real performance, not projections. When they see valuations based on, fictional future income and suspiciously minimized expenses, they often call this whole exercise what it is: fiction.
That dynamic right there, the inherent tension between seller hope and lender fiction, that's where the biggest danger lies for you, the investor. Because if you're valuing a property on what could happen instead of what is currently happening.
You're selling a dream, but you're expecting payment in cold, hard reality today.
Exactly.
And that gap between the theoretical projection, the story, and the actual operational performance, that's precisely where investors realize, often too late, that they've overpaid.
And the primary danger here you mentioned is that most people just don't grasp the incredible sensitivity of that decimal point in the cap rate formula.
They really don't. We are talking about massive swings in valuation created by truly minimal changes in the perceived cap rate percentage. It's highly leveraged, mathematically speaking.
Let's make this tangible for the listener, because seeing the numbers in action is crucial. We'll use that concrete example again. The net operating income is fixed at $100,000. That's the proven real income stream. Now, watch how the valuation changes based only on the optimism or the story baked into the cap rate chosen by the broker or seller.
Okay, if that property is valued at a 9% cap, meaning the buyer expects, or is told they should expect, a 9% return on their all-cash purchase, the valuation is calculated as $100,000 divided by 0.09.
Right. Price in calls NOI cap rate. So $100,000, 09 cents.
That results in a valuation of roughly $1.11 million.
$1.11 million at a 9 cap. Got it. Now, let's say a slightly more aggressive broker, or maybe the seller themselves, decides they want to push the price up. They claim this asset is really an 8% cap property. Maybe they found a slightly better comp, or they're leaning more heavily on that projected stabilized NOI.
Okay, so now the calculation is $100,000 divided by 0.08.
And that gives us $1.25 million.
Exactly. The valuation instantly jumps to $1.25 million just by changing that one little percentage point.
It's already a $140,000 jump.
It is, but what if they're really trying to maximize the valuation? What if they successfully argue this asset deserves a 7% cap rate? They might argue it's a safer, higher quality investment than it appears, deserving of a lower yield or return expectation.
So $100,000 divided by 0.07.
Valuation soars to roughly $1.43 million.
Wait, okay, I need to pause on that. That is absolutely staggering. We went from a 9 cap to a 7 cap, a mere 2 percentage point difference in perceived risk or required return.
Just 2 points.
And it just created a $320,000 swing in the perceived value.
Correct, over 300 grand.
And the property, the actual physical asset, the tenants, the actual income stream being generated today are all exactly the same. Nothing changed but the denominator in that fraction.
The only change was the number the buyer was convinced themselves to accept as their required return. The change wasn't in the numerator, the NOI. It was entirely in the denominator, the cap rate.
And when you divide a fixed number by a smaller and smaller decimal, the resulting total just explodes.
It does. This extreme sensitivity is precisely the core reason why manipulating the cap rate is the valuation tool of choice for those looking to maximize sale price.
Yeah.
They can change the entire price expectation, the whole narrative, with one small decimal adjustment, often completely independent of the physical reality or current performance of the asset.
But hang on. If the physical reality hasn't changed, what protects the lenders, the banks, from just going along with this aggressive 7 cap fiction? Banks are usually pretty conservative, right?
That's the friction in the market. That's the reality check. Banks have their own, often much more conservative valuation methods, and importantly, independent appraisers.
Ah, the appraisal.
Right. They might see the 7-cap price tag on the contract, but their underwriting department and the appraiser they hire will likely use a more stabilized, defensible cap rate based on actual historicals and truly comparable sales. Maybe they land at 8.5% or 9%, especially when they factor in their required debt coverage ratios.
So what happens if the bank's valuation comes in lower?
If the lender's valuation comes in lower than the purchase price, say, the bank appraisal says it's worth $1.2 million, but the contract price is $1.43 million based on that 7-cap.
Then the buyer has a problem.
A big one. The buyer is forced to make up the difference with a larger cash down payment because the bank will only lend based on their lower valuation. The bank is essentially saying, we don't believe your broker's story or that aggressive cap rate. Here's what we think it's worth based on reality. That appraisal gap can kill deals or force buyers to put in way more cash than they planned.
Okay, so we've established the cap rate is sensitive, it's easily manipulated. But let's pivot now to its fundamental limitations. What does it just completely ignore?
Yeah, this is critical.
You said earlier it's like judging a car only by its miles per gallon.
Right. And you're completely ignoring whether the engine is about to explode or if the tires are bald or if you even need a car that big. It's a very narrow view.
So what are the biggest blind spots?
The cap rate's biggest blind spot, the number one thing it ignores, is the most critical aspect for almost any real estate investor: the debt. The financing required to actually purchase the asset.
It's a cash-only snapshot.
Exactly. It provides a cash-only snapshot in a world that runs almost entirely on debt or leverage.
So let's break down these blind spots, starting with that big one, debt.
Okay, blind spot number one, cash flow after debt. The cap rate tells you nothing about your actual take-home cash after you pay the mortgage. It ignores every single penny related to financing principal payments, interest payments. This is the single biggest trap for unprepared investors.
Explain the trap there. I mean, if a property is an 8% cap, that sounds like a great return, doesn't it? Why is ignoring debt so bad?
It sounds phenomenal on paper. Absolutely, an 8% return. But let's take that 8% cap property. Now, let's say you finance it with a loan, and maybe interest rates are high. So your loan is at, say, a 6.5% or 7% interest rate.
Okay.
And maybe that loan has a fairly rapid amortization schedule, meaning you're paying back principal fairly quickly. In that scenario, the debt service to your total mortgage payment might consume 90%, even 95% of your net operating income.
So the NOI is $100K, but the mortgage payment is $90K or $95K a year.
Easily possible, especially in higher interest rate environments or with shorter loan terms. So you still have a great sounding 8% cap rate on paper, but your actual cash flow after paying the bank is razor thin, maybe just a few $1,000s, or it could even be negative.
Wow, so you're losing money each month even though it's an 8-cap deal.
Precisely. The 8% cap rate looks fantastic, but your actual cash-on-cash return, the return on the money you put down, might be close to zero or even negative. And for most investors, the cash flow hitting their bank account after debt service is the true measure of success, the reason they bought the property. The cap rate completely obscures this reality.
Okay, so the cap rate is the unleveraged return, but almost everything in the real world involves a leveraged return. That's the key difference.
Absolutely fundamental difference. Okay, blind spot number two, risk assessment. The cap rate inherently assumes all income is equally stable and reliable. It makes no distinction about the quality or risk of that income stream.
What do you mean?
It treats a highly diversified, multi-tenant office building in a prime, high-demand downtown location with long-term leases to credit tenants, the exact same as a, say, single-tenant industrial building out in the middle of nowhere whose only tenant's 20-year lease expires in 6 months.
As long as the current NOI is identical.
As long as the current NOI number is identical, the cap rate calculation is identical.
That is insane. I mean, the risk profile of those two assets is night and day different.
Completely different. The cap rate does not account for operational risk, vacancy risk, tenant credit risk, lease term risk, market risk, obsolescence risk, or geographical volatility. It strips away all the crucial qualitative judgments about the safety and durability of that income stream. It's just a number based on the last 12 months' financials, often manipulated financials at that.
Okay, that's a huge blind spot. What else does it miss? What about the future?
Right. Blind spot number three, future growth and future capital costs. The cap rate is fundamentally backward-looking, or at best, a snapshot of the current moment based on historical data.
So it doesn't see potential upside.
Exactly. It ignores potential future value appreciation from market growth. It ignores opportunities for significant future rent bumps beyond simple inflation. It doesn't account for positive market changes that could increase the property's performance years down the line.
And on the flip side, does it account for future costs?
Nope, that's the other side of this blind spot. It also ignores future capital requirements. If you know that property needs a $200,000 roof replacement in 3 years, or the parking lot needs repaving, the current cap rate calculation doesn't care one bit. It's looking backward or at the present, not forward, at necessary future investment.
This really necessitates a major reality check on how we interpret these rates then. We're often conditioned, I think, to hear low cap rate and automatically think high quality or safe.
And the conditioning, that mental shortcut, must be challenged immediately, vigorously. We need to internalize 2 critical truths about interpretation. A low cap rate generally means the asset is expensive, not inherently safe.
Expensive. Explain that.
You are paying a very high price relative to the current income because the market perceives that asset or that location to have very low risk or high future growth potential. You're accepting a lower initial yield today in exchange for that perceived security or future upside. You're trading current yield for perceived stability or growth.
So that, 4-cap apartment building in Manhattan isn't necessarily better run or fundamentally safer in its operations than the 10-cap building in Tulsa.
Not necessarily, no.
It's just located in a place where investors are willing to pay an astronomical premium, accepting a lower initial return because they believe in the long-term stability or appreciation of that market.
Precisely. They're buying the location as much as the building. Conversely, the second truth, a high cap rate often means problem child, not automatically great deal or hidden gem.
So don't just jump at a 12% cap rate.
Exactly. That 12% cap might look like an absolute steal on the surface, but it's almost certainly high for a reason. The market has likely already factored in significant risk, maybe chronic high vacancy, major deferred maintenance, significant infrastructure problems, difficult tenants, a declining neighborhood, you name it.
So the high cap rate is actually compensation for the headache.
It's the market forcing the price down significantly to compensate the buyer for the headache, the risk, and the capital they're going to have to inject to potentially turn it around. The market usually isn't stupid. It's not typically missing a golden opportunity. It's usually reflecting a serious problem or a high degree of uncertainty.
This analysis makes it crystal clear why experienced investors really treat the cap rate as merely the surface yield. Just the starting point, maybe.
At best, yeah.
To truly understand the anticipated return and, maybe more importantly, the viability of the purchase, we have to look deeper. We need to peel back the layers.
Right. This is where we get into the advanced curriculum, you might say, analyzing the 3 specific deeper layers of yield and risk that actually matter to an investor's bottom line.
We need to move past that initial sticker shock, maybe, and look at the returns the investor actually achieves once they put their money and probably their effort into the deal.
Exactly. What return do you get on your investment?
Okay, layer 1. This is the first essential correction to the basic cap rate. Yield on cost. What is that?
Okay. The cap rate, remember, looks at the initial purchase price against the current or projected NOI. Yield on cost goes a step further. It looks at the actual return based on the total capital invested. That means the purchase price plus all the immediate investment improvements, rehabilitation costs, closing costs, and any capital expenditures the buyer makes right after acquiring the property to stabilize or upgrade it.
So it reflects the buyer's total initial investment, not just the price tag.
Precisely. It recognizes the buyer's total cost basis and the impact of their value-add effort right out of the gate.
Let's put hard numbers to this. Say I buy a distressed 10-unit apartment building for $900,000.
Okay.
And I know going in, I immediately need to put $200,000 into necessary renovations. Maybe a new roof, fix some plumbing issues, update the common areas, just to bring it up to a decent standard and stabilize it.
Right. So your total initial capital investment isn't $900K, it's $1.1 million. $900K price plus $200K rehab. That's your true cost basis.
That's my true cost. Now, let's say the original NOI that asked this number was $90,000, which, based on the $900K price, looked like a 10% cap rate initially.
Okay, 10% cap on purchase price.
But through those strategic improvements I made with the $200K, I'm able to command higher rents, maybe reduce vacancy, and I successfully raised the stabilized net operating income to $143,000 within the first year or so.
Okay, nice bump in NOI due to your investment.
So what's my yield on cost now?
Your resulting yield on cost is that new stabilized NOI of $143,000 divided by your total cost of $1.1 million.
$143,000 divided by $11,100,000, that's 13%.
Exactly, 13%. That metric yield on cost, recognizes the value you created through your investment and effort, not just the value you initially bought based on the seller's numbers. It's a much more accurate picture of the return on your total invested capital.
A 3% improvement on the asset's fundamental performance through active management and investment. That's a tangible earned return. Okay, that makes sense. Now, layer 2. This is where leverage, the engine of commercial real estate, really enters the picture.
Absolutely. This is the leveraged return, often called the cash-on-cash yield. For most investors who aren't paying all cash, this is arguably the single most important return metric.
Why is that?
Because the cash-on-cash yield shows how using debt amplifies, or if your debt costs are too high, how it minimizes your return on the actual cash you have invested.
Money out of your pocket.
Exactly. Your equity. It's calculated by dividing the annual pre-tax cash flow after you've paid your debt service, principal and interest, by the actual cash equity you, the investor, personally put into the deal.
Okay, let's use the example we have. That $1.1 million total cost project that's now generating $143,000 NOI. Let's say I didn't pay all cash. Let's say I got a loan for $800,000 and I only put $300,000 down as my actual cash equity investment.
Your $300 K cash in. Now, we need the cash flow after debt. Let's assume your annual mortgage payment, principal and interest on that $800 K loan is, say, $83,000 per year.
Right. So my NOI is $143,000 minus $83,000 in debt service. Leaves $60,000. That's my pre-tax cash flow.
That's your annual pre-tax cash flow, $60,000 hitting your bank account before taxes. Now, what's your cash-on-cash return?
It's that $60,000 cash flow divided by my actual cash investment of $300,000. So $60,000, $300,000, it's 20%.
An outstanding 20% cash-on-cash yield. Now, compare that 20% to the original 10% cap rate on purchase or even the 13% yield on cost.
It blows them away.
Absolutely. This number, the 20%, is often the only thing that truly matters to the investor's personal financial goals and their return expectations for putting their capital at risk. The original unleveraged cap rate of the deal is almost irrelevant now because leverage has dramatically amplified your return on the equity you personally deployed.
You use the bank's money to buy most of the asset, and the return you get on your slice is magnified.
That's the power of leverage, but
There's always a but. Leverage is a powerful amplifier, yes, but it's also a risk multiplier. Which brings us nicely to layer 3, the absolutely crucial concept of the risk premium.
yes, the risk premium, often called the spread, is the essential determinant of financial safety in a leverage deal. It is simply the difference, the spread, between the property's cap rate, its unleveraged return, and the current cost of the debt, specifically the interest rate you are paying on your loan.
The gap between what the property earns and what the bank charges.
Exactly. This spread is your buffer. It's your cushion against any unforeseen operational dips, like a sudden vacancy, or unexpected increased costs, or even rising interest rates on variable debt. It dictates how much margin for error you have.
Okay, let's illustrate the difference between a maybe viable investment and one that's walking on a financial tightrope. Give us an example of thin spread.
Consider the razor-thin spread, which is unfortunately pretty common in highly competitive markets or when buyers overpay. Let's say you purchase a property at an 8% cap rate.
Okay, 8% cap.
But interest rates are high, or maybe your credit isn't perfect, and the interest rate on your loan is 7%.
Wow. Okay.
You are only earning a 1% risk premium, or a 100 basis point spread. 8% cap, 7% interest rate equals 1% spread.
That sounds precarious.
It's incredibly vulnerable. If just one significant tenant moves out unexpectedly, or if property taxes get reassessed higher, or if you have an unexpected $5,000 repair bill, that thin 1% margin can be immediately wiped out. You could easily be cash flow negative for the month or even the year. There's almost no room for error.
So, the moment something deviates even slightly from the pro forma projection, the debt service consumes all the income and maybe more. Scary. Now, contrast that with a healthy spread. What does that look like?
With a healthy spread, let's say you purchase a similar asset, but maybe you negotiated better or bought smarter, and you got it at a 9% cap rate.
Okay, 9% cap.
And maybe you locked in financing when rates were lower, or you got better terms, and your loan's interest rate is 6%.
All right, 9% cap, 6% interest rate.
That gives you a 3% risk premium, or a 300 basis point spread.
Right.
9% cap, 6% interest rate equals 3% spread. Now, that is a much healthier position.
Why is that so much better?
Because your money is working efficiently and you have a significant buffer against unexpected costs or income fluctuations. This 3-point spread allows the asset to absorb minor shocks, a few months of vacancy, a moderate repair, without immediately impacting the investor's ability to service the debt or generate positive cash flow. You have breathing room.
Okay, so the key takeaway here seems absolutely fundamental. While brokers often anchor the negotiation high by talking only about caps,
Constantly talking caps.
experienced, savvy investors focus obsessively on spreads, the spread between the cap rate and the interest rate.
That's exactly right. They know the spread dictates the safety, the risk profile, and the long-term viability of the investment far better than the cap rate alone ever could, especially in a leveraged scenario. Focus on the spread.
All right, we've established that the cap rate is highly subjective and depends heavily on inputs and leverage at the individual deal level. But let's zoom out for a minute and address one of the most common myths you hear repeated everywhere: the existence of a single, fixed market cap rate.
Ah, yes, the mythical market cap rate.
Every broker, every appraisal report, every analyst seems to reference this figure like it's, I don't know, etched in stone for a particular property type in a particular city.
And the phrase, oh, the market rate for Class B multifamily in this submarket is X%, is either, frankly, a tool of lazy analysis or sometimes intentional misdirection.
Why misdirection?
Because the truth is, every market, every submarket, operates within a range, often a surprisingly broad spectrum defined by intense local variables, not a single fixed number. There is no the market cap rate.
But hold on, if the market rate is essentially a fantasy, why do professional appraisers, who are supposed to be impartial, right? Why do they always seem to reference one in their reports? Are they somehow complicit in perpetuating this?
That's a fair question. Appraisers do have to establish a baseline of comparability, often for institutional comfort for the banks. They might reference a general range derived from recent comparable sales, say, multifamily properties in this area have recently traded between 6.5% and 8% cap rates.
Okay, so they establish a range.
Yes, but then a good appraiser applies dozens of specific adjustments to that range based on the subject property's unique characteristics, its age, condition, location within the submarket, tenant quality, on and on. Where the line takes hold is when brokers or uninformed sellers grab only the most optimistic end of that range, the lowest cap rate, and claim it applies universally to their specific, perhaps less desirable, property, ignoring all the necessary downward adjustments.
So they ignore the details that would push the cap rate higher for their specific building.
Exactly. There's no such thing as a single fixed market cap rate because the appropriate rate is influenced by hyper-localized, property-specific variables that can vary block by block, sometimes even building by building within the same complex.
Okay, let's detail some of those hyper-localized variables then. The factors that define the actual defensible range for a specific property.
For sure. First, and maybe most important, is occupancy stability and quality. Is the income stream reliable? Predictable? A building with long-term leases locked in with high credit tenants, maybe on triple net leases where they pay most expenses. That justifies a far lower cap rate, meaning a higher price, because the income stream is perceived as very safe, almost bond-like.
Right. Low-risk income equals low cap rate?
Conversely, a property with high tenant turnover, short-term residential leases, maybe month-to-month, or a history of high delinquency. That demands a significantly higher cap rate to compensate the buyer for the income volatility and collection risk.
Okay, so tenant quality and lease structure are huge. What about the physical asset itself, the hidden costs?
That brings us to things like utility type and infrastructure risk. Seems minor, but it matters. A property tied into cost-effective, reliable municipal sewer and water is generally viewed as safer, and thus might command a slightly lower cap rate than one relying on private wells and septic systems, where unexpected failures can cost tens of thousands of dollars instantly.
I never thought of that, but it makes sense. And general condition.
Absolutely. The broader infrastructure, risk the age and condition of the roof, the state of the parking lot, the functionality and remaining lifespan of the HVAC systems, the electrical system, the plumbing. All of it requires a potential discount. If a buyer knows through their inspection that they must budget $50,000 for immediate roof repairs, that known near-term risk must be absorbed into the purchase price, typically via a higher required cap rate from the buyer's perspective.
The price has to reflect the necessary immediate investment.
It should. And finally, a huge factor, especially lately, the factors that dictate the cost and availability of capital for that specific asset in that specific neighborhood.
You mean how banks view it?
Exactly. We call it lender confidence. How do banks view this specific property type in this specific location right now? If the market segment, say Class C apartments in that particular zip code, is viewed as high risk by lenders, perhaps due to a history of foreclosures, local economic downturns, or even environmental concerns.
Then debt gets expensive or hard to find.
Right. Debt will be expensive, require higher down payments, or might be largely unavailable except from maybe hard money lenders at very high rates. This instantly forces sellers in that segment to accept a significantly higher cap rate on their sale price. Why? Because buyers can only bring expensive debt or maybe have to pay all cash, drastically reducing what they can afford to pay while still hitting their own return targets. Lender sentiment directly impacts achievable cap rates.
Wow. Okay. So if the variables are this granular, this numerous, and this specific to the property and the current lending environment, then trying to hang a price tag on a property using a single fixed market cap rate really is a fantasy.
It absolutely is. The local lie, the myth of the market cap rate, persists because it's convenient shorthand. It simplifies things. But the critical, empowering conclusion for you, the listener, is this. There's no such thing as the market cap rate. There is only the justifiable rate that you, the buyer, can convince yourself to accept based on your own thorough due diligence, your own risk tolerance, your actual cost of capital, and your realistic, verifiable assessment of the sustainable net operating income.
Okay, we've spent a lot of time tearing down the cap rate, exposing it as a tool of manipulation, focusing on its limitations and blind spots. Now let's try to pivot. How can smart investors, and maybe especially smart sellers, use the cap rate concept effectively? How can they transform it from a potential deception back into a strategic, maybe even defensive tool?
That's a great question, because it can be a useful tool if used correctly and honestly. The smart seller doesn't just enter the conversation arguing about the rates cited by the competition or the broker. They work to actively define the appropriate cap rate range for their specific property through transparent, verifiable data.
So they control the narrative with facts.
Exactly. And they use the calculation itself to anchor the buyer in reality, not fantasy.
And we have 3 specific methods for achieving this kind of strategic application, right? The first one seems foundational. Using the cap rate formula in reverse to establish a rock-solid defensible price floor.
Precisely. Method 1. Reverse engineer value. This method forces honesty from the seller's side, first and foremost. Forget what comparable properties are supposedly asking down the street. If you, the seller, know through meticulous record keeping that your true, justified, and rigorously verifiable net operating income is, let's say, $80,000 a year.
Okay, 80K proven NOI.
And you do your homework, you look at truly comparable sales, you factor in your property's condition and risks, and you determine that the realistic market cap rate range for an asset with this specific risk profile and infrastructure is probably centered around 9%.
All right, 9% seems fair based on data.
Then you calculate your justified value with certainty. $80,000 NOI divided by 0.009 equals a justified list price of about $888,888. Let's call it $890K.
So you start there.
You start there. This provides a hard, defensible price target based on verifiable facts, not just hope or fuzzy projections. You can show the buyer how you got to that number.
That grounding in reality is essential. Okay, the second method involves using the math to stress test the asset against market fluctuations. This seems really critical in today's dynamic economic climate where interest rates and market sentiment can shift quickly.
Absolutely. This is method 2, test sensitivity. As a seller, you must be prepared to understand and even show a potential buyer the immediate impact of market changes on valuation. Use your own numbers.
How?
For instance, demonstrate what happens if market cap rates were to tick up just 1%. Maybe due to rising interest rates making debt more expensive, or perhaps increased supply of similar properties coming online, softening the market. Show the math.
Using our $80K NOI example.
Right. Show the listener or the buyer the immediate $88,888 of difference in calculated value when the realistic cap rate rises just 1% from your target 9% up to 10%, because $80,000 divided by 0.10 at 10% cap is only $800,000.
So a 1% rise in cap rates just wiped nearly $90Ks off the property's mathematically derived value.
Instantly. Understanding that sensitivity highlights the risk involved for a seller who maybe drags their feet or overprices initially, but it also signals the potential opportunity for a patient, well-informed buyer if they believe rates might continue to rise.
Makes sense. And the third strategic application. This one connects the cap rate discussion directly to the bigger picture, the macroeconomic environment, particularly the cost of money.
Yes. Method 3. Watch the debt markets. This is crucial. Remember, the cap rate itself ignores debt, but the price a buyer can afford to pay is heavily influenced by debt, and cap rates generally move inversely to the cost of debt.
Inversely, meaning if interest rates go up.
If interest rates rise, if the cost of borrowing goes up, the buyer's potential leverage return, their cash-on-cash return, shrinks dramatically, assuming the purchase price stays the same.
Because their mortgage payment gets bigger.
Exactly. So to maintain a healthy spread between the cap rate and their higher interest rate, and to achieve their target cash-on-cash return, the buyer is immediately forced to demand a lower purchase price for the property. The property must become cheaper to offset the more expensive debt.
So rising interest rates generally put downward pressure on prices, which means upward pressure on cap rates.
Correct. Savvy sellers understand this relationship and can even use it strategically in negotiations. They might say to a hesitant buyer, look, the data supports this price today based on current rates. But if you wait 6 months and the Fed raises rates another half point as expected, you will likely need to ask for a significant discount on this price just to make your own numbers work, because your cost of debt will have increased. It creates urgency based on market dynamics.
Okay, so instead of just arguing endlessly about whether the property is intrinsically a 7 cap or an 8 cap based on some rumor or broker's opinion,
Which is usually a fruitless argument.
the smart seller implements a defense mechanism built on transparency and verifiable data.
That is the ultimate actionable advice for the listener, whether you are buying or selling. Provide the meticulously detailed T12 documentation showing all income line items and all expense line items for the past 12, preferably 24 months. Be prepared to rigorously justify every single assumption behind your proposed NOI calculation.
Put your cards on the table.
Exactly. If you clearly define your historical income, you transparently account for all legitimate operating expenses. And maybe you even provide realistic estimates for necessary capital reserves. You force the other party, the buyer or the seller, to engage with your facts. They either have to accept your documented reality, or they need to show you precisely, with evidence, why they believe your past performance is inaccurate or your future cost assumptions are wrong. You let the transparent math defend the proposed value, rather than relying on market whispers or fuzzy projections.
This really brings us full circle, doesn't it? Back to the core illusion. Cap rates, despite being presented as precise numerical outcomes, are fundamentally opinions at their heart.
They absolutely are. They represent the market's collective opinion of risk and future growth potential for a specific asset in a specific place at a specific time, disguised as a simple, factual measurement.
And those opinions, as we saw, are heavily influenced by factors entirely outside the four walls of the physical property or its current P&L statement. Let's return to that powerful geographical illusion example you mentioned earlier.
Right. Imagine those two physically identical properties.
Yeah.
Let's say it's a 100-space mobile home park. One is in rural Iowa. The other, the exact same physical layout, same age homes, same type of tenants, same leaky pipes, same management challenges, is located in a rapidly growing corridor in central Florida.
Okay, identical assets, different locations.
The Iowa property, based on its local market conditions, recent sales, and perceived risk growth, sells at an 8 cap. Let's say $1 million price for $80K NOI.
All right, 8 cap in Iowa.
The identical Florida property, purely because of its location in a hot, growing market, sells at a 6 cap. Same $80 NOI, but the price is now $1.33 million.
Wow, that's a 33% price premium.
Exactly. The Florida buyer is paying a third more for the exact same current physical income stream, the same operational headaches. This is where the market's opinion about the location dictates the numerical outcome, the cap rate.
The discrepancy is enormous. We have to ask the critical question then. Is the Florida buyer fundamentally overpaying based on the pure NOI math of today's performance?
That's one way to look at it. Or are they simply under-risking the investment in their mind due to the perceived safety and upside of the geography?
What do you mean by under-risking?
The buyer in Florida accepts that lower immediate yield, the 6% cap, because they believe that the regional factors, strong population growth, maybe more diverse economy, perceived climate stability, lower state taxes, whatever the narrative is, justify paying that premium. They feel safer buying in Florida, even if the asset's current operational challenges and income are identical to the Iowa asset.
So the lower cap rate reflects reduced perceived future risk or higher perceived future growth, not necessarily improved current performance or condition.
Precisely. The 6 cap reflects the market's optimism about Florida relative to Iowa. The math, $80 K divided by $1.33 M, works out perfectly to a 6 cap for the Florida buyer. And the math, $80 K divided by $1, works perfectly for the Iowa buyer at an 8 cap. Both calculations are correct based on the price paid.
But the perception of risk, the market's collective opinion embedded in the location narrative, is what dictated the vastly different prices in the first place.
That's the key. The valuation power lies entirely in who controls the inputs, the NOI assumptions, the expense assumptions, and crucially, the underlying risk narrative that justifies the chosen cap rate denominator.
It's fascinating how much psychology plays into it.
Immensely. In the end, everyone's math works perfectly on paper on the day the deal closes. It always adds up. The question is, does it still work when the check clears and the new owner discovers the actual unvarnished operational reality behind the broker's projected NOI or the conveniently low cap rate? That's the great cap rate illusion. Hashtag tag outro.
Wow. What an illuminating, if slightly terrifying, journey through the world of cap rates. We started with a simple ratio, NOI divided by price, something that seemed concrete.
Yeah, seems so simple.
And we've discovered that the cap rate has really evolved from what was maybe once a simple, reliable compass, a basic way to gauge investment direction, into something much more like a financial mirage.
That's a good analogy. A mirage.
It might point you in the general direction of potential value, but it absolutely will not warn you if you are about to walk off a cliff built on undisclosed expense neglect, unrealistic income projections, or just overly ambitious leverage.
Well said. So our final charge to you, the listener, after all this, is to internalize this deep dive, please. Before you price your property for sale, before you make a bid on a property, or before you analyze any commercial real estate investment based on a whispered number or a glossy broker package,
You have to run the real math.
you absolutely must run the real math. That means using your truth, your rigorously vetted, defensible NOI, your realistic, comprehensive expense projections, including reserves for future capital needs, and crucially, factoring in your actual achievable cost of capital, your financing terms.
Absolutely. Run your own numbers diligently. Factor in your debt service. Calculate your realistic cash-on-cash return. Calculate your spread, that risk premium, and be prepared to justify every single input assumption with verifiable documentation and conservative forecasting. Don't trust the strobe light in the nightclub. Demand the flashlight beam on the facts.
Because in the dynamic, complex, and often opaque world of commercial real estate investing, the only cap rate that ultimately matters, the only one that protects you, is the one you can defend. Maybe even defend under oath if it came to it.